Stocks climbing back after a volatile day. The S&P 500 finishing in the green after falling nearly 4% midday. So where are we headed next? Let's get to Carter Worth of Worth Charting for some answers. Carter, what do the charts tell you?
Well, I mean, before we get to the charts, I guess the key is this: damage has been done. I think everyone knows that. The question is, do you repair damage like this quickly? And history says no. In fact, there are stats around being down more than 3 or 4% on a day and then recovering and going green. And typically it's not all that encouraging, unless, of course, an event like today, a reversal, happens after a long and protracted decline that's been lasting for quarters and quarters. This is not that. But let's look at a few charts. The first is the S&P 500, and the rest will be the Russell 2000. The key here, of course, is one, we have a break in trend. Everyone knows it. But we also have the circumstance. You see those two ovals. We made an all-time high late last year in November, and we made a new all-time high in January. Now, remembering that, look at the Russell 3000. Of course, what we know is on the next chart, we did not see a new high this year. We have a classic double top. So the broader market never really confirmed the new high that was made in the S&P, but it's the same break in trend. And so now looking at a long-term channel, this next chart is the Russell 3000, 98% of the investable capital in the United States since the '09 low. And that upper band, the lower band, these are mathematically parallel lines. And when you hit the upper band and start to draw down, typically you get to the middle or the bottom. Now, the next chart shows how far we've drawn down so far. We know we've come off 12, almost 13%. Were we simply to go to the middle of the channel, look at the next chart, that implies 18% peak to trough. Now, again, we're down 12 plus already, so that would only be another 6. Where we go to the bottom of the channel, which is perfectly reasonable as well, then you're getting into something more along the lines of 30+%. I think at a minimum, we're going to the middle of the channel, and so by all accounts, that would imply the worst is not behind us. So, Carter, let's fast forward and say we're at the middle of the channel. What other sort of signs will you look for in the charts to tell you that a likely move lower to the bottom end is in the cards? Right. So what you would, to get us to the middle of the channel, let's just start with that. We will need to have breaks in Apple, and Facebook, and Google, and Microsoft. Not necessarily breaks like Netflix, but sharp breaks that would get the market going another down leg. When you approach the middle of the channel, it's not so much that the market is there, it's how the constituents are acting when the aggregate is at that level. And when you, if and as you see stabilization, one can make the judgment that it's likely where it ends. It'll all be about how individual securities are acting if and as we approach the middle, and I think we will get to the middle. All right, Carter, thank you. Carter Braxton-Worth of Worth Charting. Dan, you've been talking about this for a month, concentration risk. Here we are. It's all going to ride on the biggest tech companies.
Yeah, so I mean, Carter's used this example before, so I'm just piggybacking a little bit. So what have we seen for months and months now? We've seen just really bludgeoning of, SPACs and high valuation tech and, throwing meme stocks in there. We're going to talk about a little. I mean, the list goes on, right? Recent IPOs and everything like that. So now they're just starting to get. So those were like the kind of the corporals and the lieutenants and the this and that, whatever. And they just got to the captains and they shoot the generals last. And that's what's happening. And look at Amazon. Amazon had a 20% peak to trough decline over the last couple of months. Microsoft was down 18% from its recent highs at its lows. We know that Apple is not immune to this. We've seen this on numerous occasions. In Q1 of 2021, just a year ago, Apple sold off a lot more than the broad market did. But right now, it's showing very good relative strength. This is not an indictment of Apple if I think it's going down 20%. Look at how many stocks have sold off 30, 40, 50%. Snapchat is down 65% from an all-time high in October. Twitter's been cut in half. These stocks are not immune. If they start to turn lower, if there's any fundamental reason to sell them, or if the market remains volatile for any reason here, they will sell off about 20%. And that's when you get those broad market, those broad indices selling off because of the concentration of those names. So I think we've been spelling it out. We're not wishing it lower or anything like that. It just makes perfect sense that that's how this works. I think then you got to wonder if Jerome Powell is going to proceed with his tightening path if we are down through that middle channel, going down towards the bottom channel. I think that's a potential major wrench in the technicals, Nadine. I don't know what your thoughts are on that.
Well, good example is that we had puts on Microsoft, and I have sold those puts. So I don't think that we can look to just like one stock, like Microsoft, and say that's going to turn it under. I get the whole concentration risk. But at the same time, you've just seen a lot of carnage out there. There's a lot of capital on the side. In terms of Powell, we've been strongly a believer that maybe he gets 2 rate hikes in this year, maybe. Maybe he'll even start this week and say he's going to do it in March just to get everybody on that path. We actually think that the GDP is going to decelerate, and he can't do 4. He can't even do 3.